Yes, I mean, we obviously like all three product types, office and industrial and retail in the net lease space. Our major focus is on the retail arena. Probably 75% of our portfolio is retail, half being that core single-tenant retail product type with Walgreens, Home Depot, Kohl's, CVS, pharmacies, the kind of the necessity retail. 25% of our portfolio is more the multi-tenant power centers and grocery-anchored retail centers as well, and then the last 25% being single-tenant office and industrial. Very active. We think the volumes in 2012 are going to be strong. 11 was a very good year versus maybe the bottom of the market in 2009 and 10 when activity was less. So we think a very good buyer-seller equilibrium in the market. The bid-ask spread is very narrow, and we think good activity in the market in 2012. Our belief is cap rates are going to be stable through 12. I mean, interest rates are low, and we think generally not a whole lot of room for compression in the market, maybe slightly in certain product types, being a single-tenant retail, maybe in the most because of the activity. The 1031 exchange buyer activity is stronger in that product type versus maybe office and industrial, and then the multi-tenant market, more institutional competition. But we think generally all those markets will be strong in 2012. One particular area of activity is the sale-leaseback arena. We're seeing a lot of activity with private equity groups, going public, going private. So they're using the sale-leaseback as a form of financing of their transactions. So we're seeing large portfolios of single-tenant retail primarily. In one case last year, we did a BJ's transaction with multiple stores and a couple of distribution facilities as well. So more of that type activity going forward. In office and industrial, we're seeing tremendous activity in the market. Generally, cap rates are almost at historic lows, and interest rates being low, it's a great time to be a seller. So we think it's also an opportunity for us to buy these facilities. In most cases, not at peak prices, maybe in some cases below replacement cost. So we think it's still a great time to buy real estate in the market. Sure. I mean, our investment strategy is really to buy long-term credit leases, whether that is an office building, a mission-critical facility, or a retail user, a necessity retail user box like a Walgreens or a Home Depot, Walmart. So those are generally long-term leases, which in today's market are very readily available. Financing's readily available for those product types. Really, rates are at historic lows. We are a low-leveraged borrower for starters at that 50% loan-to-value range, and we like to see interest-only loans because it allows us to pay our dividend. So we found the markets to be very attractive for debt, both CMBS and life company, and we're also active with the major banks as well for 5 to 7 year money. So we like to maybe be a third. Obviously, certain markets at certain points in the market, those are more competitive versus others. So we'll modify that as necessary, but generally like to be active in all three of those markets. As I mentioned, rates are at all-time low. We match up the long-term loan to our long-term lease, which really locks in that cash flow long-term for our investors. So we think certainly rates should be low for the next couple years. We think there's a great bid-ask equilibrium in the market. There's a lot of volume, so we think it's a great time to own real estate, and a great time to finance it as well, to really lock in those yields long term. I mean, obviously what we look at is just the general health of the economy is a driver for the real estate business. Job growth is clearly a significant factor in the need for commercial real estate, probably most notably in office, but also in retail and industrial as well. So when people have jobs, they spend more money. It helps the retailers generate sales, which generates need for warehouse space and the general health of the market. We look at the fundamentals of the market as well, the vacancy rate, the rental rates. But in our investment strategy, it's less critical because we have that long-term credit lease. So it's really further out versus a maybe a value add or a distressed buyer it's more critical on the current fundamentals of the market. General consumer confidence is obviously important for retailers. The people that feel good about the economy and their job and their situation will tend to spend more money, which obviously drives the retail sales in our product.
Excellent.